The Federal Reserve just cut its key interest rate by 1/4 percentage point. While that might sound like a small technical change only bankers care about, it's a decision that will ripple through the economy and directly impact your mortgage, savings, and credit card interest. This isn't just background noise. It's a signal about the health of the economy and a move that will change the math for your personal finances. We're going to break down exactly what the Federal Reserve did, why they did it, and most importantly, what it means for your wallet. We'll get past the jargon and give you the straightforward information you need to navigate what comes next. Let's get right to it. The Federal Reserve, America's central bank, has officially lowered its benchmark interest rate. This brings the new federal funds rate to a range of 3.50% to 3.75%. This is the kind of headline that can cause a lot of confusion. Is it good news? Bad news? The truth is, it's complicated. Whether this helps or hurts you depends entirely on whether you are a borrower or a saver. This single decision can change the cost of a future car loan, reduce the interest you earn from your savings account, and even influence the stock market. So if you have a credit card, a savings account, a 401k, or are even thinking about buying a home one day, this news matters. Stick around as we unpack it all. Before we get into the consequences, let's quickly clarify what we're talking about. Who is the Fed, and what is this rate they just cut? Think of the Federal Reserve, or the Fed, as the financial manager for the U.S. economy. It's the central bank, and its main job is to achieve two goals: promote maximum employment, meaning as many people as possible have jobs, and maintain stable prices, which means keeping inflation under control. The main tool the Fed uses is the federal funds rate. This isn't a rate you or I pay directly. Instead, it's the target that commercial banks charge each other for overnight loans. You can think of it as the foundational cost of money. When the Fed lowers this rate, it gets cheaper for banks to borrow. That cost saving tends to get passed down to consumers and businesses through lower interest rates on all kinds of loans. So when the Fed's voting committee decides to cut the rate by 0.25%, they are essentially tapping the accelerator on the economy. They're making it cheaper to borrow money to encourage spending and investment, which should stimulate economic activity and support the job market. This most recent cut to a 3.5% to 3.75% range marks the third time the Fed has lowered rates this year, signaling a clear response to signs that the economy is slowing down. It's a delicate balancing act. If they cut rates too much, they risk runaway inflation. If they don't cut them enough when the economy is weak, they risk a recession. Every decision is a calculated move based on massive amounts of economic data. So the logical question is, why did the Fed make borrowing cheaper right now? The answer lies in the data and the risks they see on the horizon. The Fed is walking a tightrope between its two mandates: keeping people employed and keeping prices stable. Recently, the balance of those risks has shifted. A primary driver for this rate cut appears to be the labor market. Recent reports show that job gains have slowed and the unemployment rate has ticked up slightly. For the Fed, a weakening job market is a major red flag that calls for action. By cutting rates, they hope to make it cheaper for businesses to borrow for expansion, new projects, and most importantly, hiring. It's a preemptive move to support the job market before a small slowdown becomes a bigger problem. The other side of the coin is inflation. The Fed's long-term target is 2%, but inflation has been, quote, somewhat elevated, hovering closer to 3%. It hasn't been accelerating, which gives the Fed some breathing room, but it's not back to their comfort zone yet. This is where the balancing act becomes critical. Some Fed officials felt it was too soon to cut rates, with inflation still above their target. However, the majority evidently believes the risk of a significant downturn in employment is now a greater threat than the risk of inflation reigniting. They're making a judgment call. The danger of a cooling job market currently outweighs the danger of sticky inflation. In his press conference, Fed Chair Jerome Powell was careful to manage expectations. He emphasized that this cut doesn't guarantee a long series of future cuts, stating the Fed will remain data dependent. This highlights the uncertainty that still clouds the economic outlook. They are trying to engineer a soft landing, slowing the economy just enough to tame inflation without causing a recession. This rate cut is another attempt to gently guide the plane onto the runway. This is where it really hits home. How does a quarter point change in a rate for banks affect your personal finances? The impact varies depending on whether you're borrowing or saving. For borrowers, mortgages, car loans, and personal loans. When the Fed cuts rates, many people ask, will my mortgage payment go down? The answer isn't that simple. Fixed rate mortgages, the most common type in the US, are not directly controlled by the Fed. They are more closely tied to the yield on the 10-year Treasury note, which is influenced by long-term expectations for growth and inflation. A Fed cut can influence these expectations, but it doesn't guarantee mortgage rates will fall by the same amount. Often the market has already priced in an expected cut, meaning rates may have already drifted lower. You might see a slight dip, but don't expect a dramatic slash overnight. However, it's a different story for adjustable rate mortgages, ARMs, or home equity lines of credit, HELOCs. Their interest rates are often directly tied to a benchmark like the prime rate, which moves in lockstep with the federal funds rate. If you have an ARM or a HELOC, you will very likely see your interest rate and monthly payment go down, usually within 1 or 2 billing cycles. What about car loans or personal loans? These are shorter term and their rates are more directly influenced by the Fed's actions than 30-year mortgages. When the prime rate drops, banks are more likely to lower the rates they offer on new auto and personal loans. It won't be a one-for-one drop of 0.25%, but the trend will be downward. This means financing a large purchase could save you hundreds or thousands in interest over the life of the loan. For credit card holders, if you carry a credit card balance, this rate cut is good news. Nearly all credit cards have a variable APR tied directly to the prime rate. When the Fed cuts its rate by 0.25%, the prime rate also falls, and your credit card APR should follow suit, usually within a couple of statement cycles. While 0.25% may not sound like a lot, on a $10,000 balance, it saves you about $25 in interest per year. After a couple of years where every Fed move made debt more expensive, the tide is starting to turn for savers. Now for the other side of the coin. If a rate cut is good for borrowers, it's generally bad news for savers. The interest you earn on savings is also influenced by the federal funds rate. When it's cheaper for banks to borrow money, they have less incentive to attract your deposits with high yields. If you have money in a high-yield savings account or a money market account, expect the APY to drop. Online banks in particular are usually quick to adjust their rates after a Fed move. So the high returns you may have enjoyed over the last year are likely to start ticking down. The same goes for new certificates of deposit, or CDs. If you're already in a CD, your rate is locked in. But if you're looking to open a new one, the rates offered will likely be lower. In a falling rate environment, some savers consider locking in a longer-term CD to secure a decent rate before they drop further. Even with this cut, rates are still much higher than the near zero levels of a few years ago. But the days of ever-increasing savings yields are over for now. Beyond our bank accounts, the Fed's decision sends powerful signals to investors and businesses. What does this mean for the stock market and the economic outlook? For the stock market, lower interest rates are generally seen as a positive. It can boost company profits by making it cheaper to borrow for investments and expansion. Lower rates also make stocks look more attractive compared to safer assets like bonds, which now pay less interest. This can push stock prices higher. However, the reason for the cut matters immensely. The Fed is cutting rates because it sees a slowing economy. This creates a tug-of-war for investors. On one hand, lower rates are a plus. On the other, the underlying economic weakness is a negative. If investors believe the Fed's action will successfully prevent a recession, the market may rally. If they fear a recession is coming anyway, the market could fall despite the cut. This rate cut is part of a broader shift in monetary policy. It comes after the Fed recently decided to stop shrinking its massive bond holdings, which it had been doing to fight inflation. For the past couple of years, the Fed was in a tightening cycle. Now we are clearly in an easing cycle. The priority has pivoted from fighting inflation to supporting growth and employment. This is a delicate moment, and the coming months of economic data will be crucial in telling us whether the Fed made the right call. Navigating these economic shifts can be tricky, but staying informed is the best way to make smart money decisions. If you found this breakdown helpful and want to stay updated on how economic news affects your finances, make sure to subscribe and turn on notifications. We post regular updates to give you the clarity you need. To recap, the Federal Reserve cut its key interest rate by 0.25%, bringing the new target range to 3.5% to 4%. This was the third cut this year, made mostly due to concerns about a slowing job market, even with inflation still a bit above target. For you, this means if you're a borrower, With variable rate debt like credit cards or a HELOC, your payments will likely go down. If you're looking for a new car or personal loan, you may find better rates. The impact on fixed mortgages is less direct, but the overall trend for borrowing costs is downward. On the flip side, if you're a saver, expect lower returns on high-yield savings accounts and new CDs. For investors, the move is a mixed bag, a welcome stimulus prompted by underlying economic weakness. The Fed is walking a fine line, trying to steer the economy to a soft landing. This was a measured step, not a panic move, but it confirms that the era of aggressive rate hikes is over. We're now in a new phase where the central bank is focused on protecting growth.